Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, March 8th, 2024. S&P 500 currently sitting almost exactly where it was at the end of last week, 51.33. I'm David Zarling. I'm here with our local bracketologist, Ian McMillan. Ian, obviously the market just went nowhere from last week to this week, just flat.
Yeah, that's what it'll end up looking like, which I guess, is a fair way to view things if that's your time frame, if you look at weekly candles. But yeah,
but even if you look at a weekly candle,
major indices down. Yeah, I think as of right now, Russell is the only one that's positive on the week. Obviously, everything was great until just a few hours ago. They sold stocks, but we have seen this many a time in the last 4 or 5 months. So.
Well, and I would add a couple things here for perspective, is that since the October 23, November 23 flush and panic buying breadth thrust sequence, if we were to close negative this week, it would be only the third negative week since that time frame. Price action this week actually engulfed or is outside the price action of last week. So market doing a good job pulling in buyers and sellers this week to interact, and sometimes volatility picks up in that type of environment. And if we record what's called a doji candle on a weekly time frame using the S&P 500, we might have some indecision on our hands, right? That would be a behavioral marker where we've had quite the run. Could we pause here? But like you said, we've had this before and kept going.
Yeah, I mean, it's still a pretty strong uptrend. When you zoom out, it's hard to say that any damage has been done yet, which, if we're sitting here talking about the market being flat, then, yeah, probably very little damage in general done on the week. Under the surface, pretty good.
Yeah, I was going to say, what do you mean by that? So underneath the surface, pretty good this week. Can you expand on that for our listeners?
It was horrible. I think that, NASDAQ was the worst. Like I said, small caps are still positive. I don't know what mid caps have done this week. They might have even done better. Mid caps are up 1.8% this week. Yeah. NASDAQ's down 1.4.
Well, that's
not all is horrible, and obviously when the NASDAQ underperforms, it will be just as much of a headwind as it was a tailwind when it was outperforming, which probably not a lot of people are prepared for, because it's all fun and games until those concentrated areas, like I said, become a headwind. Which leaves, that doesn't mean it's bad for the market. That doesn't mean stocks go down or the S&P goes down. It's just a headwind. And opens the door for other areas to outperform.
Well, the sports analogy would be, right, when your star players go down. So let's call it Tesla, Apple, and Google, right? All negative year to date, while the market's
Apple just now it is up today, but
here you have an environment. If I can use the Milwaukee Bucks, right? If you have Giannis and Damian Lillard sitting on the bench, and all of a sudden you get quality minutes from the rest of the team, isn't that quality?
Has that been a good trade? How is Damian Lillard been? Good. Yeah, it's working out.
Yeah, I think he's a good shooter. What's interesting about, obviously he was the MVP of the All-Star game, and when he plays loose, he doesn't miss. And so I think the coaching challenge will be making sure he continues to play loose. And when he was at Portland, he didn't really have a player like Giannis that he was playing next to, so being able to play with another individual, and same thing with Giannis, he didn't have someone like Damian. So a lot of the two-man game, they're still learning. And I think they're only going to get better. What I've appreciated about Doc Rivers taking over the team is they've definitely gotten better defensively. And defense wins championships. Obviously, in the NBA, you got to score. But I think it's good. I think they're starting to show signs, although they got smoked by Golden State the last game. They were, I believe, didn't have a loss after the All-Star break. They're allowed to lose once in a while, right? Like markets are allowed to have a negative day, a negative week, right?
Yeah. And we will continue. We've already seen it in we are literally 3 hours into I don't even think small caps even negative. Okay, they just did go negative. We are 3 hours in to an intraday 1% correction. And you have the same people, the same characters. They get frantic, right? We talk about it when they tap the fishbowl. We talked about this weeks ago. Tap the fishbowl, and everyone wants to be the first in line to call a top. If Apple came out with a call the top product, these people would camp outside the Apple store because everyone wants to do it. Is this it, Dave? This might be it. This might be it. How many times have we done this? Flinching has not paid off for months. Eventually, it will, but still a very, very strong trend.
Well, yeah, I was going to say, by definition, the trend following process is you're not going to be out at the top and you're not going to be in at the bottom. And that's just the reality of the situation. So the idea that you think you can top tick a market.
Well, and the argument's going to be, right, if let's say we closed right now, well, look how far we closed off the highs. Well, look how far we closed off the lows of the week. It's a doji. Now, it feels, right, it feels panicky because it's all happening on a Friday morning / afternoon. But I would tell you, worrying about what the candle looks like on a daily basis. And how many times have we had some not great looking daily candles, even weekly candles throughout this process? It has been a pure ride the trends until it's over. There's been so many, and I get, from a technical perspective, there have been reasons to flinch, right? We've talked divergences of the momentum, divergences in breadth. You could argue both of those have maybe fixed themselves.
Well,
obviously we're coming off an entire year of the Magnificent Seven talk. So I think that's still in back of a lot of people's minds. But here we are.
I think it's interesting where in previous market regimes where you saw the Magnificent Seven move lower or the large cap names move lower, you saw small caps move lower even more still, like at a greater degree. And when you look at what happened this week, it's quite the opposite. You mentioned mid caps. When you look at small caps, even micro caps, those are all on an absolute basis green this week, or on a relative basis outpacing the S&P 500. And that continues to confirm the thesis we've talked about several times on here, that the breadth thrust that took place in late October, early November of 2023, that's where we saw small
It's still in effect, yeah.
It's still in effect. That's where we saw small caps begin to outperform. We continue to see that type of behavior, even while Apple and Google and Tesla continue to look or struggle or look like, I'll say, like a hot mess. And that's okay. Like if you had told me, I think we talked about this last week, if you had told me that Apple would be negative double digits for the year, that the market would be up, I would have said that.
And significantly up. It's held together very well. It's not like just 6 of the 7 are now participating.
Well, what I was going to say is in a real simple way to identify what's been going on is when we look at the performance of NVIDIA during that same time frame, it's basically replaced half of an Apple from a cap size perspective. You had another player, you had a rising star show up in the league and take some of the slack away from Apple's responsibility to this market, which not many others would necessarily have on their bingo card as well. That you're seeing a situation where does NVIDIA later this year.
The baton has been passed to the maybe the second runner in the relay. I will say. So when you get these things like Whaley breadth thrusts, or we've talked about it before, Ryan Dietrich and the amazing deep dive statistics that he posts. A lot of this comes with all right, looking 6, 12, 24 months out. What does the market look like after a breadth thrust or a price thrust, or however you want to divvy up the slice of bread? And so everyone agrees, right? Everyone agrees when these things happen, like, wow, this looks like it's going to be pretty bullish for the market for potentially multiple years to come. And then we get 4 months into it and we get a red day, or God forbid 2 red days, and people clamor to again, call the top, or they want to get worried after we just got done discussing, the long-term, not to use this word again, but tailwinds that a lot of these events that have already happened should provide for the market. So we all agree that there are multi-week or multi-month and potentially multi-year trends setting up. And then we want to worry about a 1030 sell-off in NVIDIA. Just humans are funny. That's all I'll say.
Yeah, we are a funky bunch. Like the fact that NVIDIA gave so much to this market over the past more than 6 months, and you have a potential bearish engulfing today. Again, you will never be able to top tick the market, and having NVIDIA pause at this point would be extremely healthy. And so if you have individuals or institutions looking for this is the end of the bull market, this is where it's appropriate to remind them we just reclaimed all-time highs for the S&P 500, for the NASDAQ 100. We're still 18% off the highs for small caps. VT, representing total world index, so representing the stock market of the entire world, just got back to its 2020, late 2021, early 2022 highs. So a 0% return since early of 2022. And you're telling me that this is the end of a bull market seems a little bit disingenuous. Now, if you want to de-risk and you think there's going to be some kind of corrective behavior in March due to seasonality, fine. That's fine. But again, this market has done a good job leaving those who aren't willing to participate in the dust and not giving them a way to manage risk. If the correction in semiconductors begins at this point, meanwhile you have small caps carrying the intermediate to short-term baton going forward, you need to be aware of that. And as technicians, we can do that. We can look at semiconductors versus small caps. We can look at these different relationships and see mid caps and small caps versus the S&P 500 have been leading since the breadth thrust late last year and are really in a solid setup. They continue to get bid higher in a way that we haven't seen since April of 2022. We're early. We're in the infancy stage where many want to believe that we're far along what a bull market. And I would argue that price disagrees with that thought process. So what else, Ian? What else are we wanting to highlight for our listeners? Equity related, it could be bonds, could be crypto, commodities. What would you like?
I think Bitcoin still around 69, 70,000. So we'll see. Maybe it's sold off. I haven't looked at it.
Yeah, it's sitting at 68,500.
68, yeah. So we're there. Not much movement. Like I said, a decent sell-off on Tuesday, but back to where it was. Tech, discretionary, comm services, your worst performers on the week. Makes sense. If I told you NASDAQ was down the most, those 3 sectors should probably come to mind. At least 2 of those. But on the flip side, Dave, you have staples and healthcare at new relative lows, and utilities not too far behind.
So those would be.
So, yeah, there's no divergences there in regards to strength. We talk about relationships all the time. High beta versus low vol holding up well. Now with the turn of the market, obviously these defensive sectors are looking a little better, but the point still remains very weak. And financials, holding in there, they're actually in line with the S&P. They've outperformed since the October lows, and they're in line with the S&P over the last 3 months. but still kind of just hanging out here on a relative basis. That continues to be the one I keep an eye on the most. Industrials just got above their relative 200-day this week. So that needs to be on everyone's radar. And a flattening 200-day in that relationship. So getting better. But financials, I mean, we talk about it all the time. Everything with banks is kind of working in financials. I mean, insurance looks great. We talk about broker dealers. They're up near all-time highs. But banks just, no fault. They had a very good Tuesday. And the market had a rough Tuesday. But no follow-through from that.
This goes back to, if you look at financials as a whole, right? You look at XLF. Looks great. Right. We are entering where the correction began in January of 2022. And so do we see a pause here in financials overall? You could. We've seen other areas of the market move through this area. So when we observe price behavior, when selling of most stocks began anywhere from early 2021 to late 2021, and in this case, XLF or financials broadly speaking, at the beginning of 2022 is when that corrective behavior began. We're back at that behavioral level. Could you see selling here? You could. We've also seen other areas where they've reached this similar area for their respective area, and they've cut right through and moved higher. And so we'll see. And this goes back to participation versus relative behavior. Is XLF, in this tremendous uptrend versus the S&P on a relative basis? No. But is it moving in an uptrend on an absolute basis? Yes. And this would be a spot where we want to pay attention at this $40, $42 level for XLF. Is there enough demand to push through previous supply where it's a behavioral marker? This is a place where you would, quote unquote, expect to see selling. And this goes back to what is it?
Some type of supply.
Right. And this goes back to, as a technician, you don't sit there and say there's going to be supply here. You say this would be an area of interest. This is an area where we would have seen selling in the past. Are the sellers going to show up again here? And when they don't, or if they don't, that's when we really need to pay attention.
Just like they didn't show up at 37.
Right, correct.
They didn't show up at 35. They didn't show up at 37. They didn't show up at 38. They didn't show up at 39. I mean, these are all, I'm using round numbers here. But go back and look at the chart. So we'll see. And there's a momentum divergence there, but I don't know. I'm going to be honest with you, Dave. These are the types of, and so if I'm looking at a 14-period RSI, XLF, clearly, we have made higher or lower highs on RSI over the last 3 months. But I put an asterisk next to it because all these highs are still overbought. And that's what leads to these grinds.
What's so bad with overwhelming demand?
Yeah, and that's what leads to these grinding periods like we've seen. I mean, take an XLF. The RSI divergences, we've had the MACD bearish cross. It's just been one of those periods where pure trend following. And I think a little bit of understanding the sentiment of the market and how hated this rally has been. I think that's also been a little bit of the art versus science. This has been an incredibly, it either caught a lot of people off guard or people are just angry in general. But it has not been a well-received last 3 to 4 month market rally.
Yeah, still in disbelief mode, skepticism mode. We saw an increase in the put-call ratio this week, just indicating individuals willing to take on whether it's hedging or downside bets. Again, that can tend to be the lifeblood of a market in addition to rotation, right? Seeing that sector rotation, seeing style box rotation, cap size rotation, that's normal behavior for the lifeblood of a market. But so is when investors should get nervous when people stop shorting the market, because all shorting is individuals who are promising to buy in the future. And
didn't you post something yesterday about put call ratio going up?
Correct. We saw put call ratio rise. higher than we've seen in the last 3 months. And so
Wow.
there is
That's
skepticism.
crazy to me.
Yeah, like there are willing participants to short at this point. Let me be clear. I don't know their time frame, individuals taking those type of positions. So those positions might be correct in the near term, the next month or so. I'm not here to say that they won't make money taking a short position now through the end of March or now through
They were all 0 DTE.
Right. It matters the time frame that we're talking about. Even if we have correction now into summer, it doesn't negate the uptrend that's now upon us. And getting back to XLF, the financials as a whole, what's interesting is 3 of the top 4 holdings, weighting wise, have already cleared their 21 and 22 highs.
So obviously JP's and Berkshire's have got to be.
Berkshire has not yet. It's right near its all-time highs, near 71, 72.
Warren? Okay. Because we have to go back.
Yeah, but JP Morgan, Visa, MasterCard, the next 3 in line, these are ones that have cleared their all-time highs, their previous all-time highs. And so I think it'll be information if we see Berkshire do the same thing to move through its previous all-time highs. Now,
see, I would say it has moved through its all-time highs.
You must be using Berkshire A shares?
I'm using BRKB.
See, and I've got them below 72.30. Now you might be using, no, for my chart, both dividend adjusted and all time, I still have them below their March 22 highs.
Okay.
Now, hold on. I mean, this could be operator error for whatever reason. And we love TradingView. So I'm going to say this, like, let me be clear. We love TradingView. For whatever reason, it was pulling up the UK version for me. So priced in British pounds. So you are correct. All of the top 4, Berkshire.
That's some pretty solid foreshadowing.
Yes. So Berkshire Hathaway, JP Morgan, Visa, and MasterCard all have cleared their late 21, early 2022 highs before XLF. And that we've seen this happen across how many sectors now, Ian?
Okay, well, I've got go ahead. I got another example for you.
Right. All I'm saying is that the stars of the sector, so for example, semiconductors, NVIDIA, when we look at communication services, things like Google and Meta, or you look at healthcare and you're looking at Eli Lilly and UNH, when these things lead and they clear their highs before the overall sector does, that tends to be a precursor to the sector as a whole moving higher. So go ahead. What were you going to say?
So one area that's been really prevalent does get 0 attention, but so Lindy.
Oh yeah.
It's the number one holding in materials.
Been a boss.
And it is it's responsible for over half of the return in XLB over the last year.
And how many households, how many people are you going to be talking to over the weekend who are like, man, can you believe this Lindy stock?
So many mention it at the cocktail parties that I attend.
It's one thing I appreciate about you, Ian, is your sarcasm. It's good. Yeah, like no one's talking about Lindy.
I don't even think, I'm pretty sure it's an ADR too.
It is. And so
yes.
It's interesting. So that XLF or financials as a whole up against its prior highs, you could see selling here, but it is important information that we're seeing Berkshire, JP Morgan, Visa, MasterCard all clear those levels already. So the stars of the team, the stars of the league have already moved through there. Is that foreshadowing further behavior? And if so, how bearish can this market be if financials are breaking to new all-time highs? And not only that, not just American financials, but European financials. Like, are we really getting bearish if EUFN is clearing levels that we haven't seen since 2018? I mean, we're on the verge. We're on the doorstep using that measurement of seeing price levels we haven't seen for 6 years. So if European financials demand is outpacing supply, American financials demand is outpacing supply. Typically, environments where financials are participating the upside are not bearish market environments. I'm not saying they have to outperform, but on an absolute basis,
it's hard.
Yeah, that's quality information to be looking at. And I think that falls into, is there a shift into value? Many would say, oh, small caps are value oriented. That's to be determined. And here's the deal. We could still see a corrective march, right? We've had a historic, I think you've highlighted, since November, we've had a historic period of time in performance for the market.
Yes.
And if we get a pause,
7th best rally in basically 80 years, 8 decades of the S&P.
Say that again.
So
what is it?
7th best rally.
7th best rally
in 8 decades.
In 8 decades
of the S&P.
We're in the top decile.
So, I mean, this is not even once a decade do you get a rally like this in this short a time frame. None of them have ever led to a major market top. If anything, they've just led to more months and years of a higher market.
If people haven't been participating in this market, you better hope that there's a pause here so you can get on the train. And we could be seeing that. Like, we're not here to say the market goes in a straight line. We could pause in March. We could move lower in March. We could move lower in March and April. But this goes back to price leads sentiment. And if we get that type of behavior, it'll be interesting to see how much more bearishness or skepticism enters the market when people really should be using that as an opportunity to get involved, to get on the train.
Can you imagine if we got a 5% correction, how just bloodthirsty participants would be? I mean, they would be adamant that we're done.
Well, again, we could pull all the way back into 4,800 on the S&P 500, which would not feel comfortable. I get it, right? People love it when their accounts and when the market goes in a straight line, but we're only talking about 6%, and that would be pulling back into likely a rising 200-day moving average.
That's going to throw people into a tizzy, Dave.
Oh, absolutely.
A 6% correction?
Yes.
And can you imagine if we went below 4,800 for a bit?
Yeah. I mean, you could go all the way into 4,600, a 10% correction, which we typically get one
Dave,
of those.
Stop. All right, we'll stop right there. We'll stop right there before Dave manifests any evilness.
Right. But it would be perfect.
But no, I hear you. It's perfect. Golly. Right, and because when you zoom out, you'd be like, oh, that's nothing. And it is nothing in the grand scheme of what is likely to develop again in the coming months, potentially years. But it'll feel rough in the moment.
And when you use charts, right, when you use technical analysis, which is the study of supply and demand using charts, red days aren't always negative. For an example, if I can use an example, and bear with me, Ian, so I'm gonna try to paint this for our listeners, and I'm actually throwing a curveball to you because it's not in our show notes. But when we look at small caps, okay, the behavior on January 31st, 2024, so big red down day, a discount day, interestingly enough, upped the auction level, the point of control for small caps overall. So on a down day, buyers were stepping in mass. My point with this is both that's a huge development for small caps overall. That's showing that there is demand in this market at higher prices than we've seen since April of 2022. The second piece is the market. I don't know that you want a market that's green every single day. Like, would we love it at the surface? Absolutely. That feels good to have just nice, calm, quality returns. But even a red day like today is wonderful for the trend as a whole, right? You can't, if you have just nonstop green days, it's kind of like an airplane taking off. If you keep climbing at a vertical rate, you're going to run out of oxygen for the fuel. And so it doesn't matter how much gasoline you've got, you're not going to be able to ignite it. Same thing with markets. If you just go in a straight line vertical, you're going to exhaust the buyers and all that's left is sellers. And so this type of price behavior in a market is so healthy. And even if we had a March and April that were corrective, extremely healthy behavior that I know that we'll be looking to take advantage of, even though we're already pretty well taken advantage or allocated towards this market trend. Hopefully that made sense as I described it. My point being that red days, negative days, don't dictate the overall trend and are healthy behavior for uptrending markets until they're not. That would be going back to what we talked about last week with when is the thesis wrong? Well, below a 200-day, below 4,800, this is where you'd start to question the upside thesis. But that's 6% away, would be perfectly normal behavior to be able to take advantage of. But people don't want to hear that. They want, it's either up or down. Like people want either top tick the market or somehow be grabbing onto a rocket ship.
And they want it in a straight line.
Right.
So even if you look at some basic, let's say today's the top, just for sake of conversation.
Okay.
We're going to go from the Halloween lows through today.
Okay.
So when we look at like a basic Fibonacci retracement, so even looking at like a 38.2, a 38.2% retracement, or I'm sorry, yeah, a 38.2% retracement of this rally, not of the overall market. We are not retracing 38.2% of 5,000, but just of this recent rally. I mean, that brings us back to 4770, below 4,800.
Yeah.
And that would be very natural, very mathematically natural. And that's not even a 50% retracement.
Right.
Or a 61.8.
Right.
Which I could argue could even more common. In a healthy uptrend like this, I would be, a 61.8 takes us to 4,500. You can absolutely bet if we get down to 4,800, the squawking will be loud.
Markets will be in turmoil.
Yeah. So we'll see.
Yeah, we will see. And I think there's a couple things that we could be looking at. If the Berkshire Hathaways, the JP Morgans of the world are breaking their previous highs, if we can't sustain trade on the total world index at its current price levels, if small cap.
What do you use for
VT? Victor Tango?
VT. Yeah, we'll see. We'll see right there, huh?
And so we could pause here. Same with leverage products. If you're looking at a leveraged S&P, we're right at, this would be a logical place where you would see a pause. And this goes back to last week's episode where, are you ready to be a BTFD? Because it's not the mantra, and it's the harder thing to do, especially if you're in this mode of, it's a bubble, or, it's too far too fast. And when the market...
Yeah, because any time of correction will just play into that.
Correct. And when it starts to pull back, I was right.
I was right. I was finally right. I told you.
I told you the market was too far too fast. I told you it was a bubble. And so therefore, psychologically, you won't get involved. You won't use information underneath the surface to see where the strength is and to get involved once that corrective behavior.
I mean, imagine if the NASDAQ pulls back 7 and Russell pulls back 2.
Yeah. Amazing information.
But they won't care. They won't care because the headlines, the tweets, the Substacks, it's all going to be about the NASDAQ. And yeah, like we said earlier, it can be a headwind. You don't have to be involved in the NASDAQ.
Well, and I would argue that all the news headlines that you're talking about, one thing that our listeners should be aware of by episode 198 is that the media does not have your best interest in mind. Case in point, I'm going to pivot away from markets. A former president was kicked off of Twitter because he compared COVID to the flu. The Wall Street Journal, within the last 10 days, released an article saying that the CDC now views COVID as the flu. That tells us everything we need to know. Like the fact that a former president who suggested that COVID was like the flu got censored and kicked off of social media platforms. And now the Wall Street Journal gets to say that that's the case based on the CDC. I'm here to tell you, I'm sorry, listener, that the media does not have your best interest in mind. In fact, I'm going to guess that 80 to 90% of the time, it's trying to sell you ads. And that's an uncomfortable situation. And at the same time, I'm super thankful because that's our ed, meaning we're not going to use news. We're not going to use politics. We're not going to use any of personal opinions on how to position within a portfolio. We're going to use price. We're going to use ratios. We're going to use trend. We're going to use relative strength. Those are the 3 pillars. Doesn't matter what the headline is, but what Ian is pointing to is that you could see a 6 to 10% correction, and he's already foreshadowing what the headlines would look like that would cause a listener not to take action. When we're in this environment where we just saw breadth thrusts that have very strong characteristics for 12 to 36 month returns going forward back in November and October of last year, will you be ready to take advantage of any type of corrective behavior now through April? That's really the determining factor. And most can't handle that because they're so inundated and consuming information that comes from media rather than consuming information that comes from charts. I am now off my soapbox, Ian. I apologize for that.
No, you're fine. All I have to add is so you are correct that I don't listen to financial media. I don't even think, do we even buy any sell-side research anymore, Dave?
We do not.
Not even from the technical community.
No.
Which we shouldn't need to. We've got 4 CMTs. We should be able to do our own research. But the point is, I am fairly certain in saying that late October, early mid-November, there was not a single soul on TV telling you that markets could rally 25-30%. And it would be a wonderful opportunity for wealth creation and to obviously, right, kind of hedge against all the inflation and the price increases in the rest of our lives. It was a great opportunity to do that. We've talked about it at Lunch and Learns a lot. When we talk about inflation, one of the best areas to be is typically equities. I'm not saying they happen right at the same time, but those things do get priced in. And right, stocks are a denominated asset, just like anything else.
Well, isn't that interesting, Ian, that the current, and I'm not saying this is sentiment among clients or even the general populace, but hey, we need to adjust for inflation. Meaning, like anything that you look at, whether it's an NFT, a crypto, a bond, a stock, a commodity, we need to adjust for inflation. Why is that the new norm? Were we adjusting for deflation before? Were we adjusting for stagflation before? No. Let's be real, that price is price, the denominator is the denominator, and that's what we have to operate off of. I don't get to go to the trade desk and say, hey, can you execute this on an inflation-adjusted basis? That's not how this works. At the same time, I can also flip this and say the very reason we are involved with markets is not because they're friendly, is not because they're fun. If they're fun, you're probably treating it like a casino. I have some reservations there, but pivoting back to, we're involved with markets to preserve our purchasing power.
Yep.
Period. And Ian's point,
and have enough there at the end. Yeah. And if you're not keeping up, then
that's problematic for your retirement plan.
As I said, I don't know what to tell you when you get to 65. But you bitching about it as the market rallies, pardon my French, it's not going to change the numbers in your bank account.
Right. And I love that you've used French in the last 2 episodes. I'm not as versed as you. I'm with you on that. The market is not game. The market is not your friend. The market is a leveraging in process for preserving your purchasing power. And if there is inflation, the market and technical analysis will actually show you where that is, show you where you can maintain your purchasing power using relative strength.
Outpace inflation.
Exactly right. Because if you're going to hold 5% T-bills while inflation's at 8%, you're now running at a -3.
And I know it feels good and it's easy, and sure, you can sleep at night. You can sleep at night in the short term. Yeah, you're right. The U.S. probably not going to default on their 3-month T-bill. But it's not a plan in this type of environment to both maintain and grow your wealth. Let's just be honest, what the new standards and costs of life are. We're not putting the toothpaste back in the tube. We're not. I'll tell you that right now.
In regards to inflation,
people think that their life's the things are gonna be more affordable when rates go down. Are you kidding me? You think you're finally gonna be able to buy that house when rates go down? No, that's not gonna happen. Especially if you haven't been keeping up in the meantime.
The market is the best way to be involved with protecting your purchasing power. When I say involved with the market, that has varying degrees. Is it international? Is it small? Is it large? Is it tech? Is it value? That's why we use technical analysis. It goes back to the practice, the study, the expertise in dealing with supply and demand. And sometimes I had a conversation with an advisor earlier this week, chartered market technicians, those who show the expertise of dealing with portfolio decisions in a market setting. We discount our knowledge when we should be preaching it more to the masses to understand where is the strength, where is the weakness, And we need to be able to take advantage of the strength and avoid the weakness for the sole purposes of the individual who is entering retirement or in retirement that wants to travel, has health issues, has a place where they want to live. These are all things that cost money and purchasing power.
I mean, what about even pre-retirement? College.
Right.
You want a vacation home. You want to upgrade your car. You want to move to the neighborhood on the other side of town. You want to get your kid in a better school. So we do talk a lot about planning for retirement, but there's also, it's not going to slow down because you were frustrated and decided you were just going to sit in T-bills instead of stocks for a year.
This goes back to our last episode where peak T-bill was last year. And wouldn't you know that the major sentiment of, like, can you park me in T-bills marked a major turning point in this market. And that our listeners need to be aware that, and I think sometimes people forget, why does the market exist? From one side, it's companies who are raising capital, right? You go and you have an initial public offering because you've exhausted your credit options in the private credit or public credit markets. So you go issue stock to help carry out your mission. And then on the flip side, an individual is involved in that because they want to participate in that company or in that stock. But what's the exchange? You're doing that because you're trying to preserve your capital. You're trying to preserve your purchasing power. And sometimes I think we forget that as investors, is that we're not as red and green light flashy as many platforms are to make it feel like a casino. That's not what this is about. This is about preserving your purchasing power. And so if you have thoughts of, oh, should I own T-bills and get that guaranteed 5, that's fine. I'm not saying that's a negative thought, but in an environment where inflation's at 8% year over year, you're now saying I'm willing to sacrifice purchasing power for being comfortable. And that's where advisors need to step up, and they need to do their fiduciary duty and say, hey, Mr. and Mrs. Client, I understand your need for 5%. However, you're not going to maintain your purchasing power for healthcare expenses, living expenses, being able to travel and see your grandkids' expenses. If you sit there and park there, you're going to have to be involved with the market. That's exactly why we're involved with the market. And we forget that. For whatever reason, investors have become very short-term and myopic. We need to get away from that. We need to understand why we're involved with markets. And the reason why we're involved is to maintain that purchasing power. I don't know how I got onto 2 soapboxes on one episode, but I did.
Yeah, I think we've both been a little soapboxy. Hey, that's okay.
It is. And we haven't even talked about gold yet.
Gold breaking out. Yeah, it's been a good rally since you mentioned the client letter that was sent out yesterday. But strong, yeah, we'll see. Now, on a relative basis, do I want to own gold over stocks? That is a more debatable question.
It is.
But absolute basis, congrats. We broke 2100 after 12 years of waiting, 13 years of waiting, I think, actually. But is it the best asset to allocate capital and time and energy and brain power to? Again, that is the real $1 trillion question.
And I think that's the question that investors, institutional and retail, need to be asking themselves right now. And here's why I say this. When you look at where, and I'm going to try to meld multiple asset classes together because I do believe crypto is its own asset class. But when you look at Bitcoin versus the S&P 500, we're at a very important, or close to, within 5 to 10% horizontal price levels. When you do that same comparison with gold versus the S&P and gold versus Bitcoin, we're at a pivotal point. March of 2024 is a pivotal point of those 3 asset classes, or those potential options to invest in. And it's going to be really interesting to see how this resolves. Because, right, Bitcoin is the new thing on the block. And wouldn't it be something if we launch 11 Bitcoin ETFs plus derivative ETFs is the talk of the town, and gold outperforms from this point forward? We don't know if that's the case, but we're right at these, what I would call, inflection points on those relationships where you could see gold start to outperform. And wouldn't that be something, that you would have this environment where gold starts to outperform when it was stocks and it was Bitcoin, the sexy stuff. Because gold's not sexy. Like, are you kidding me? This is where it starts out to perform. We don't know that. Like, everything I just said could be completely negated with S&P 500 moving higher versus gold, with Bitcoin moving higher versus gold. But both of those relationships are right at important levels. We'll see. Time will tell.
Yeah, I think that's a great point. It's the same argument. Bitcoin, I know gold looks great, and I know gold is the darling of, you could argue maybe an entire generation. And I know it's exciting to see it move higher on your statement, or every time you log into your brokerage account after being flat for over a decade. But that doesn't mean it's the best asset to own.
It's all about that relative strength. That's what it is in the end. And we could see a pause here in equities. We could see them pull back during the rest of March. It would be perfectly normal considering the performance we've seen of equities for the last few months. As you mentioned, we're in the top decile. When we look at what's happening underneath the surface, as we started the podcast with, it is interesting to see aerospace and defense strength. We'll see if that continues to play out. And without going on a fundamental soapbox, incumbents who are at this part of this low of an approval rating, there tends to be some type of conflict that ends up happening in the year of their election. Like it or hate it, what I'm insinuating, the fact that aerospace and defense are doing what they're doing, do we get to see some type of conflict escalated or initiated by an incumbent president? Time will tell. And I'll stop right there and say, let's pivot to junk bonds. As you mentioned, strength out of mid caps, small caps. I would say junk bonds.
Junk bonds not too shabby.
Yeah, like
consolidating.
Yeah.
Same place they were at in December, which, yeah, I'll take it. And more importantly, if you look at them compared to their risk-off counterparts, duration equal counterparts, they continue to be in an uptrend. People would rather own junk bonds than intermediate-term treasuries. So, another risk-on relationship that continues to point to a pretty healthy investing environment.
It does. And we're bumping up against the end of our time. I always love doing these with you. We hope our listeners really appreciate it. I always like highlighting those who support the podcast. Speaking of which, Adaptive Select ETF, which is listed on the New York Stock Exchange under ticker ADPV, helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. We bumped up against the end of our time. Ian, anything else you want to highlight for our listeners before we sign off?
I don't have anything.
Other than Gamecocks, big Saturday game coming up. We're now heading into March Madness, right? All the conference tournaments are happening this next week.
Yeah.
Which sets the stage for NCAA March Madness bracket selection, which you did a great job educating me on how they're doing this now, which we're not going to be able to spend time with our listeners on. Maybe in the following weeks we can talk about that. But it's a great time of year for whether you're talking about NFL draft, beginning of baseball season, March Madness. It's an amazing time. So good luck to your Gamecocks this weekend. I appreciate you guys and everybody listening to this that enjoys this, appreciates the information we're putting out there. Please share it or give us a high ranking. That's a compliment to us. It assures us that we're on the right path. If you could do that, we'd really appreciate it. Thanks again, Ian, for being on here.
Have a great weekend, everyone.